Hey everybody, Top Gentile, welcome to our series, our fall series, even though it's not officially fall yet. Unofficially, summer ended earlier this week. Anyway, I want to welcome all of you Optionetics students. Glad to have you back. So school is back in for most of the kids. Mine are back in college again, and I'm sure any of you that have sons and daughters back at school, you are somehow, some of you are relieved, some of you are maybe not relieved, you're a little sad. Maybe there's a mixture of both. That's what I see. I see kind of a bittersweetness to school. And mine are at the, just to give you an idea, mine are at the end of their education, unless they want to go for masters or PhDs. I've got mine will be graduating. Well, one's graduating in at the end of this year, and one's graduating in spring with bachelor degrees. So absolutely amazing. That's one area of theta decay that I cannot control, is my own. And so anyway, I want to welcome all of you guys here. I might as well go ahead and get the disclaimer up there. We'll talk about that in a moment. Let me just give you the rules, especially for those of you that are new. We've got a lot of new Optionetics students that are just now finding us. And so I'll talk about that in just a moment. But this is our Trading Essentials webinars, and we do these a couple of times a year. They are absolutely free for Optionetics students, our lifetime attendance groups. And so what we do here is we try to emulate what we used to do in the two-day live events. Only what we're doing now is we're breaking them up into sessions, and we're trying to take out as much of the fluff as possible and really just, hone down on what it is that is most important at that time. And so what I'll typically do is I'll go through a few weeks and we'll do the foundationals to options, which is all about calls, all about puts, all about spreads. We'll talk about spotting opportunity. Tonight, I'm going to discuss a couple of different things. I ran the high-low scan, and I want to talk about what the high-low scan is and how I use it, because today was a very interesting day where we saw a lot of pullback, especially in tech. But then there were new highs that were made too, and so that's one thing. Buy the high is definitely something that I believe in, and I'm going to show you how we approach that. We'll talk about spotting opportunity. We're going to talk about Darknet as well, which is really kind of our version of Elliott Wave. Creating low risk trades. I'm going to use something called Double Finder tonight. I haven't used that. I didn't use that the last time we were all together. So any of you that are returning, you're going to get to see Double Finder as well. And I've got no less than 3 trades that I'm looking at that we'll be utilizing as case studies. One of them I got into at the end of the day, but I got to tell you, it's been an absolute long day. I unexpectedly had to return to New York. Typically this is the time where we start packing up and heading south, but family emergency put me right back up in New York again, and so I don't know how long I'm going to be here, but anyway, I got a studio up here, and I am going to be up here for the duration. We'll go through all of this during this session, and during all of our sessions, you can ask questions. Now, I'll let you know there are a lot of people in this room tonight, and a lot more that registered that are probably going to be coming in as we continue. But we'll try to take the most popular questions, and I'll make sure I answer as many of them as I can throughout tonight. Keep in mind that I'll let you know this. Well, it pretty much says it right there on the board, that stock and option trading has large potential rewards, but also large potential risk. We all know that. All right. We also know that that trading might be easy, but consistently making money, well, that requires a little bit more effort. And so what I'm going to do is I'm going to show you a bit of what I do on a regular basis that keeps me consistent. In fact, last week, I think the last week to 2 weeks has probably been the best for the entire year for me, personally. All right. And so I'll show you what it is that I have been doing. And in fact, I'm going to tell you what it is I'm going to do over the next couple of weeks as we go through case studies. I'll talk a little bit more in overview. Also, keep in mind, and I'll say this about the disclaimer too, myself, Jay Harris, who's in here with me tonight, and everyone associated with Optionetics and Tom's Trading Room, we're here as educators, okay? We don't give personal investment advice. We're not stockbrokers. We're not investment managers. We're here as educators under the publisher's exclusion law, which allows us to teach what it is that we do. And so just keep that in mind. Obviously, you need a broker to trade with. There are certain requirements you have to be met. And then everything I'm going to talk about tonight is in US dollars unless noted otherwise. So a lot I want to cover with you tonight, okay? For those of you that are returning, I mean, I've been around a while. I actually started trading back in 1986, actually. I was 21 years old then. Since then, other than blowing out of my entire account in 1987, the day after the market crashed, from that was really a big learning lesson for me. And since then, I've kind of traded pretty much everything. I would say 25-year veteran is probably getting closer to 30 years, as I move up in age. All of you know I was one of the co-founders of Optionetics. We had over 400,000 students during the time frame that Optionetics started until it was we had merged and were then taken over by Charles Schwab, big discount broker. Got several books out there in print, although I haven't written any through a publisher in a while. I'm actually thinking about penning another book, but I've done a couple of them that were self-published, and you can find them on tomgentile.com. All right, so that's a good place to go. In fact, I got one up there now on cryptocurrencies because yes, I trade cryptocurrencies. I actually mined them several years ago, so I have a few coins in the crypto bank. Tom'sTradingRoom.com and Tom'sOptionTools.com are a couple of other places you can go to, and we'll talk about Tom's Option Tools as well a little bit later because I'm going to be using that site. All right, our site, which is really kind of an upgrade for Platinum. We'll discuss that too. So why did I buy Optionetics back? I get that question a lot. If you're so good at this, why did you buy Option? Well, Optionetics cost money. All right, it wasn't free. All right, we sold Optionetics. I can safely say I paid less than us as a collective group sold it for, but it was still not cheap. Didn't have to do it. In fact, my wife asked me not to in the beginning. She goes, "Why? Why would you want to do this? You're doing so well on your own. Why would you want to add more work to what you're doing?" And I told her, the two reasons I did it was, I did it for George because George really, he never really thoroughly bought on to the company being merged and then being bought out. He wasn't a big fan of that. But there were a lot of shareholders with Optionetics. I was probably one of the smallest shareholders of Optionetics, but that was part of the reason. And part of the reason was I did it for the students because we saw that niche kind of drop and go away, and I wanted that niche to come back, especially for the long-time students that were the students that were around since the 90s and the students that were around since the early 2000s. That saw the changes, and we bringing them back. But also technology allowed me to do this because, now we can do this right here in the comfort of our own homes. All right, me teaching, you watching right there on the laptop because, this wasn't something, yeah, we were doing it, back, in 2000 and I think 2005, all the way into, testing some of the stuff in 2011, 2012, etc. But we never really did it on the two-day platform. And so, on the Trading Essentials platform. So that's what I did. And it just made sense. It made sense to me. It made sense to a lot of the students. And I want to thank all of you for the comments you've given me about getting Optionetics back and taking back over. And I hope that you'll continue to see that we're providing what I believe to be a much better value than where we were a year ago, all right, or just a little bit more than a year ago. So let's kind of continue on here. I want to welcome back all the students. Both the old students have been with me before. I've been doing this on my own now since 2014, and then of course our new students, which are finding us. All right, I still have Optionetics students that are finding us and saying I didn't know. I hit optionetics.com. I had no idea that you were back at the helm again, and I'm very excited about doing that. And I've brought over some of the what I felt were the best instructors that we had, the ones that really just looked out for the student, and that's people like Devin Pearsall, Christina Nugent, Mike Wade, Jeff Beamer, Joe Contes. And so, these are guys that were with us for a long time, and they were as excited as some of the students when I asked them if they could be part of, just a small part of the year as we go along. So we're real excited about that. The other thing I want to mention too is that Platinum. Now, a lot of know, questions, what happened to Optionetics Platinum? Platinum's been upgraded. All right, we took Platinum and put twin turbos on it. It's the best way I can explain it, and relaunched it as tomsoptiontools.com. All right. If you haven't had a chance to look at it, check it out. We have a free trial over there for those of you that have not ever used it before. I can honestly say it is so much better than what you saw in the past. All right. And I'm going to be sharing that with you over the next few weeks. And then, of course, we also do the more advanced seminars. I'm not planning on talking about those tonight. I'm not planning on talking about those next week. I'm not planning on talking about those through the whole webinar. I'm just letting you know that they're there, and we offer them sometimes during the year. We typically do one mastery program with each of our instructors per year. That's the only time we do it. We don't have this curriculum that just goes on and on and on and on, because honestly, we all have we all have things to do with our time as well. And there's a lot of things on my bucket list, and there's a lot of things on all the other instructors' bucket lists that they want to do. And so I can get them once a year. And so that's what we do. So this Essentials webinar series, the next 3 weeks, we're going to go from 8 until whenever. I'm guessing around 9, might run over a little bit. Recordings will be made available. We're going to email them out to you following the live event. Any slide handouts from each webinar is also going to be made available. I will have the slides in the email to you tonight along with the recording. All right, so tonight's going to be all about calls, puts, and darknet, but I've also added a few extra things that I thought might be something that all of you could grab and do on your own. Okay, because yes, darknet is a proprietary software. I'll let you know that right away. But this HILO thing is really something that anybody can do. All you got to do is literally pick up a paper and look at what's going on with new highs and lows. But I'll show you how we scan for it. You're gonna walk away tonight, if you haven't done this before, with exactly how I get my stock list. All right, so we're gonna do that first. Next week, we'll do a review. We're gonna talk about spread trading, and we're gonna trade with the money calendar. And it's gonna be interesting because next week, the money calendar, all the easy money has really kind of been happening the last couple of weeks. And we've had a little bit of pullbacks. I think Friday we had a little pullback. Today was an interesting day because we opened down and the blue chips and the Dow came back. The NASDAQ a little bit, but I mean, there were some tech stocks that ended lower, Facebook, Google, but you also got stocks like Amazon and Apple that are racing. It's like a horse race of who's going to be a higher market cap. Amazon came on today as the second $1 trillion stock. We'll talk about that too. And of course, week 3, what I want to do is I want to show you how we trade like a professional options trader. And so what I'm going to do is I'm going to share with you some of the stuff that I do every single week, from top-down analysis to looking at darknet, to looking at money calendar, to looking at other money patterns. Okay, so week 3 is going to be really a kind of a high-level week. All right, so I'm going to stair-step you up this program over the next few weeks. Let's start with where the best tradable stocks are, because there are so many of them out there. All right, you've got if you look outside of like the New York Stock Exchange, there's probably a good 20 to 25,000 stocks in the universe. Well, all of us in this room, if you're an option trader, you know that 25,000 stocks don't automatically trade options. Options trade around the area of roughly, let's say, a little bit south of 4,000. So that's one thing I do. But I look at market liquidity. I look at whether that stock actually moves. Okay, part of that is the price of that stock. So if the price tag on a stock is is less than a certain amount, then it may not be worth trading the option on. And then of course, short-term optionable. What I mean by short-term optionable, I mean I'm looking at stocks that have weekly options that trade. So that really cuts us down from a large list to a much smaller list. Now, market liquidity. All right, you want to find the greatest liquidity in the stock market, then go to the CBOE, www.cboe.com, or you can go to cboe.org, and that'll take you to the Chicago Options Exchange. I just clicked on that so I could show you what we're looking at here. Now, this is an area you could go into. The other thing you can do is if you go to the .org site, or we can go into products, and you can drill yourself down. You can go in here till you're crazy. But there is another way that we can go in and spot the best stocks to create your stock list from. So I want to show you how to do that right now. So what we can do is we can Google, because everybody knows how to Google, and you can get there very, very quickly. If you type into the Google area the words Penny Pilot Program, that's going to take you to the CBOE Penny Pilot Program. And then from there, we can click on that list of stocks. And now you're getting the list of stocks that I use. All right, so let's just do that. So if you go to Google, www.google.com, all right, I'm just going to go straight into Google. And right in here, I want to type in Penny Pilot. In fact, as soon as you get to PILOT, you can just scroll down and you click on Penny Pilot Program. And then that very first one there, Hybrid Penny Pilot Program, click on that. And what that does is that takes you to the Penny Pilot Program. It took us past all the junk we needed to get to, straight to where we need to be. And what you're going to want to do is you're going to want to click on this link here. It says click here for a .csv file of Penny Pilot classes. I'm going to click on that right now. Look what happened. Now, it depends on what you're using. If you use Microsoft Excel, it's going to put it into Excel spreadsheet. If you use some other form of spreadsheet, it should put it in there. Worst case scenario, it'll open it in some sort of a Word file. But I'm going to show you what it looks like. So I'm going to go ahead and open that up and share that with you. And there you go. So this is the Microsoft Excel spreadsheet. And what I'm showing you here is that it's got 4 different columns, all right, and a lot of rows. But you can see here, as I scroll down, how many stocks are in the Penny Pilot Program today? 402. All right, it says 403, but that's also row 1 is a header. But 402 stocks. And these are stocks. Now, what are these stocks? What do you mean Penny Pilot Program? What does that actually mean? That means that the bids and the offers on the options, all right, are inside the 5-cent bid ask window. So that means they actually trade in pennies. All right, so for example, let's say you got an at-the-money call option. One that's not a Penny Pilot stock might trade $3 by $3.25. All right, one that's in the Penny Pilot Program might trade $3.04 by $3.07. As you can see, it's inside the 5-cent bid ask. All right, so that's what Penny Pilot classes are. You can download that. You can then save that. You can use that as your list. All right. If you use, and you can use that to just, go through and find stocks that, see if your stocks are part of the Penny Pilot Program. Now, if you use our software, we can actually save this as a list and we can scan from it. All right. But I'm sure there's other ways you can do that as well. I just want to show you where I go to get the most current list. Is I get that at cboe.org. All right. So that's the Penny Pilot Program, and I wanted to show you that because that takes us from 4,000 stocks, optional stocks, down to 400, and that's the top 10%. So what I do is I take that 400 and I incorporate it, and I look to see, of that 400, how many of them trade weeklies? That drops the list down to about 325. Right, so that's what I'm dealing with. And if you take a look at, for instance, let's say we're looking at, 25,000 stocks. 25,000 stocks down to say 325. You're inside the top 2% of all traded stocks. All right, that's what we do. Okay. Now, why do I trade options? Any of you that are Optionetics students, and all of you are, you know this. We do it for 3 reasons. Control, because we're actually controlling a large group of stock. for a much smaller price. Protection in so much that the stock could drop to zero if we bought a call option. Stock could drop to zero, and we're only out the price of that call. Right now, that rarely happens, but it does happen. We've seen it happen before, and we will see it happen again. And then, of course, there's ways of paying for that protection, and that offsets your options. It might even offset how you're looking at the market. For instance, maybe you're looking at it in a non-directional view. Maybe you're looking at it in a mildly bullish or mildly bearish view. Okay, so that's why we trade options. So I want to talk about calls. Although calls and puts we're going to cover tonight, but the call option area is where I'm going to be looking at case studies for tonight. So very simply put, calls give you the right to buy. That's it. The right to buy what? A specific stock at a predetermined price by a predetermined date. And puts give you the right to sell. All right, so calls are bullish, puts are bearish if you're going to be a buyer of each. Okay. So for instance, if we're looking at a call option, maybe I'm looking at something like XLE. This was a stock that we did a trade back. Well, I mean, back here in February earlier of this year, we were looking at there's a pattern we look at every single year. It's the energy pattern. All right, because I'm a pattern trader. I like trading patterns. I like trading things that happen over and over again. And while there's no guarantee that it's going to continue in the future, that's my style of trading, right? There are plenty of different styles of trading. There's fundamental, there's technical, there's seasonal or pattern trading, right? The one reason I like pattern trading is simply this. I can, with enough data, and I have enough data, I can get an idea of what it is I'm going to be looking at next week, 2 weeks from now, next month, 3 months from now, because the patterns start and end on specific dates. All right. But I'm also a pattern trader when it comes to technical indicators. And I'm also a pattern trader when it comes to fundamental data. So I'm a pattern trader, but you can find patterns in fundamental analysis. I find patterns in earnings reports all the time. You can find patterns in technical analysis. That's what I was turned on about Elliott Wave so much, and why we've created, my programmers and I've created what we think is a great Elliott Wave program, because it's static. It doesn't change wave counts. A buy is a buy, whether it's in good times or bad, and we found some really good patterns with that. And of course, there's patterns that are time-based, and I'm going to get into those next week. But you see the move where we have a stock that's a $68 stock. In this case, it's an ETF. We have a target of around 75 to 80. All right. So at that point, and the pattern, the opportunity was the 5-month energy pattern from mid-February to mid-July. All right. So much more often than not, oil, gas, and anything in that sector typically moves higher. All right, if you go back and look, I believe 13 of the last 15 years, that's actually happened. So at this point, I move from spotting the opportunity to creating an acceptable risk trade. That's where I use options. So questions about buying XLE. How many options can I buy for $68 a share? Well, that's called your contract size, and that can be as many as you want or as many as you see fit. Just keep in mind that contract sizes, one contract is good for 100 shares of stock, right? Can I buy XLE options at different prices other than 68? Yes, those are called strike prices, and that's going to affect what you pay for as well. And how much time you have on your option? Well, that depends on how much time you buy. That's called your expiration date. We'll go into each of those very quickly. So contract size, 1 equals 100. That means one contract is good for 100 shares of stock, right? That's in the United States. There are a few countries that have 1 equals 1,000, but that's kind of changing. And the reason why they had 1 equals 1,000 is because their stock prices were so cheap. They needed to have some sort of leverage to make people think, okay, maybe it's worth buying an option. All right. But very few countries offer 1 equals 1,000. So 1 equals 100 is almost the standard. Strike prices. Well, that's the price that you agree upon as a buyer or a seller. Okay. And in this case, it's not 155, it's 68. It's $68. Let's fix that little problem right now, because I do these, I keep these almost as current as possible, $68. So that's the price that the buyer can exercise the option contract for. You know, if you have an option contract, there are really three things you can do with it. All right, you can sell it to someone else for the market price, you know, or a limit price that you agree on ahead of time. That doesn't mean it's going to get sold at that, but you can put that in. The second thing you could do is you could exercise that option and take the stock at your strike price. So for instance, if XLE is at 75, maybe you want to exercise the option and that allows you to buy the stock at 68, even though it's trading at 75. Now, why in the world would you do that? Well, you could just sell the option and take the profit. Well, by exercising the option and taking the stock down here, you are somewhat deferring your taxes, all right, until a future date. Now, I'm not a tax attorney. I'm not a certified public accountant. So you would need to find out how that would affect you by talking to either a tax attorney or a certified public accountant. But those are the two things that can be done. The third thing is, if you're a buyer, probably the worst thing you could do is let it expire worthless. Something that I try my hardest not to do. It's not that hard to do. You just set a stop for yourself and you get out in the case that things are not going your direction. Expiration dates. Okay, so there are expiration dates. The most popular one is the one that occurs on the third Friday of each month. That's a monthly expiration. It's the one that's been around the longest. All right, it's the one that has the most fanfare with option traders. Although weeklies are becoming very popular now too. In fact, weekly options account for over 20% of the total option volume now, where just 10 years ago they barely existed. There are Wednesday options now. There are even Monday, Wednesday, Friday options now on things like the SPY. So there's a lot of different expirations that are being tested. All right, I don't trade the Monday, Wednesdays on a regular basis because I'm not, the volume just isn't there yet. And once I understand it a little bit more, I probably will be as a short-term trader. But for right now, I am just kind of, the shortest term I typically look at are the Friday options, the weeklies. Other options with expiration dates are EOMs, which are called end of month. That's the last trading day of the month. There are also options that are quarterlies. They expire on the last day of the quarter. All right, and then leap options. And leap options are options that have greater than 9 months to expiration. So what's your best? That depends on you as a trader. All right, if you barely have time to be in this webinar because work or family or you've got other obligations that are taking up your time, you don't want to be a weekly option trader. Okay, what's probably going to happen is you're going to spend not enough time as a weekly option trader, and you're not going to spend enough time on your job, and you're not going to spend enough time on your family, and things just get out of balance. You have to find out what options work best for you based on your current situation. Don't try to make an option work for you. You need to find what options work, you know, what options or what type of option trader you are that works best with your life. Okay. So that's when I say what's best, that's what I mean. There are definitions for options, and you know, these are, I mean, I could get into this stuff forever and ever, but it's very simple. I mean, 3 types of options that I look at. In the money has mostly real value. Those are the ones I typically am buying if I'm a short-term trader. I like the in the money options because they're quality options. Out of the money options, I'm typically a seller of. Right? Because they don't have real value and there's a probability that it actually goes low. The only time I buy out of the money options is if there is a pattern that's suggesting that I do. All right, or did I see something like volatility that'll be rising in the future? Then yes, I'll buy an out of the money option. All right, but typically I sell out of the monies, and I'll typically sell the at the money option in some cases. It's a flip on the at the money. Sometimes I'm a buyer, sometimes I'm a seller. In the money, most of the time I'm a buyer. Only time I'm a seller of an in the money option is if I bought it earlier and I'm trying to get out of it, right? I mean, the last couple weeks, AMD treated me really good. Apple treated me really good. Google, really good. Amazon, really good. I mean, just it went on and on and on. I mean, it was like the pins, were all getting set up, and all I had to do was knock them down. And we'll get into exactly what I'm talking about here in just a few minutes when it comes to spotting opportunities. But for those call options that I bought, well, I ended up selling several of them at a much higher price than I bought them for, because of the moves that we've had just in the last 2 weeks. Okay, so volatility. And volatility, I just mentioned, that's the speed of the stock relative to its time. There's two types of volatility we use in predicting stock movement. First is statistical. Now, I'm going to be sharing with you one stock, which is a case study tonight on statistical volatility. All right, and you'll see what I'm talking about when I show it to you. Implied volatility is what we look at on options themselves. So statistical is past stock movement. Implied means present and potentially future stock movement in present option pricing. Okay. Now, some of you might wonder how does the market know how much an option costs? Well, remember, at the end of the day, it's supply and demand. And as supply dries up and demand increases, that makes option prices go higher. And I'm talking about really, when you think, wow, the stock hasn't moved much at all, but this option keeps ticking up. Well, that means something is spooking option traders that is likely to occur in the future. And maybe that's why there's this big rush to come in and buy calls and potentially buy puts, right? So again, you're looking at a chart of XLE. The difference is now I've got another red line on here. So this is the price chart, and this went all the way out to the beginning of the year, January. And then, of course, look what happened between January 26th and about the 9th of September. We went from 78 down to 65. That was a huge drop in a short amount of time, but this was setting up for the energy bull run. Now, look what happened with implied volatility. These are the option prices. And option prices all of a sudden started spiking and going up before finally starting to settle back down. So what we like to do as option traders is we like to buy low and we like to sell high. What I mean by that is we like to be looking at buying option strategies when this red line's on the bottom of its range, and potentially selling option strategies when it's on the high end of its range. The good news is that we can put both of these charts together and get a really good read on what it is we need to be doing at any time with any opportunity. So a side-by-side comparison might look like this. Let's say you were long 100 shares of this XLE at 68, but then the trader next to you was long the 68 call. You're putting out $6,800 for 100 shares. At the time, that call option costed $432. Your risk, even though it's very, very minimal, is the price you paid for the stock. The risk over here, even much, much less minimal, is the price you paid for the option. Your break even is where you pay for the stock. The break even on a call is going to be strike price plus the cost. So in that case, that pushed us up to $72.32. That's the kind of the payback. All right. If you're going to get something cheap, there's a reason. Somebody who's selling it to you has to have some sort of reason because they're equally convinced you're wrong and they're right. And so they're getting a little cushion here. But you can see, looking at the profit when we did back in February, 77.5, that was 9.5 point move. If we can get a 9.5 point move on the stock, these options are likely to double in value, more than double in value. In this case, a 15% return on the stock becomes an 110% return on these particular options. All right, this is an example of how that would be put into a brokerage account. So the long XLE call, all right, and this shows you here, this was on February 15th, all right, note the time, and in February 15th, we're looking at the September 21st. Yeah, the options expire now. 68 calls, 425 by 440 at the time, all right? At the time we were discussing this, and by the way, Optionetics students, and some of you know who you are, we were talking about this back in February when I did a session for everybody on energy opportunities. In fact, not only did I do that session, but I actually had a small booklet that I put out with all of this in it. All right, Yeah, I'll do it again next year. So good till cancel order. That just means if it doesn't get filled today, perhaps it gets filled tomorrow, perhaps it gets filled next week. All right. And then this is what your option looks like if you look at it on a risk graph. All right, we know how much we paid for it, that 432, but look at the upside. The upside is unlimited until you get out of the actual trade. Okay, so that's the call options, the right to buy the asset. Now, trading puts for profit are literally the same thing. You have the same characteristics as long calls, but in down markets. So they have the same 1 to 100 contract sizes calls. They have the same number of strike prices and expiration dates, but puts increase in value as stock prices decrease. And guess what? We are going to get a market that's going to decrease. Problem is nobody knows when it's going to happen, but there are some patterns out there that have been working very, very well, and we'll be discussing those next week on the decrease side. So at this time, Jay, I want to open up your microphone, and I want you to let me know if there are any questions out there that I need to answer based on where we are so far.
You know what, Tom? They're all tracking fairly well. One guy asked when you talked about the end of the month, the last day of the month, are you talking about the trading or business day or just the calendar day?
Okay, very good question. It is the trading day, the last trading day of the month. So the last trading day in August was actually August 30th, which was also the last calendar day of the month. But you're going to find that some, sometimes the last trading day of the month is not the last calendar day of the month. It just happens to be the last day you trade. And those are options. I'll let you know this too. End of month options do not have the kind of liquidity that weeklies do, that monthlies do. They're not a real popular option for me. I find that leap options in many cases have more volume and tighter bid-ask spreads than do the end of month. All right. Anything else, Jay, or shall I continue?
I think you're good to go, Tom. Thanks.
Awesome. All right. Cool. Okay. So let's go ahead and move into what I like to call spotting opportunity. And I got tonight is Darknet. Before I get into Darknet, I want to show you something that all of you in the room can do. And it's actually really I think it's a great start to tonight. And so I'm going to leave this session here for just a moment. And I want to go into, well, there's our penny pilot program. Let's get rid of that. I find the less stuff that's on my screen, the faster my computer goes. And so here we go. So let's go over to, I'm going into Tom's option tools, and I want to show you something that I'm sure you could probably find this somewhere. Maybe it's within your brokerage site or not, but we have something on here. We do a lot of ranking and analysis. Some of this analysis you can find pretty much with other sites, and some of it you can't. But one you can is called the HILO ranker. And so all the HILO ranker is the ability to rank. And what I do is you can put in a number of weeks you want to rank. So I like to rank highs and lows. For instance, I like to rank quarterly highs, and I like to rank yearly highs. And when those two guys are actually kind of happening at the same time, that's really interesting. And so, but we're going to just look at yearly highs right now. So we have a market that right now, a lot of stocks are hitting all-time highs. But then we also have it just in the last, let's call it the last couple of days, we've seen some pullbacks on a lot of stocks. So what I'm going to do is I'm going to take that penny and weekly list that I shared with you how to get, and I've got it in as part of my stock list, and I'm going to look at stocks with the highest close for the weeks chosen, which is 52. The last 52 weeks on pennies and weeklies, I'm running the search, already done. All right, so out of those stocks, as you can see, Lululemon is up here on top, NVIDIA, Visa, Marathon, United Continental, Qualcomm, Boston Scientific, PayPal, and the list goes on and on. Over here on the right-hand side where it says close low, high low, if it says 100, it is on its 52-week high right now. And so, I look through this and I'm seeing, are there any stocks in here that I was trading just within the last couple of weeks? I come down, NVIDIA was one, all right, moving along. Boy, I missed so many of them though. AMD, absolutely. I was in that in the low 20s, and that's already at $28.06, which I think is just unbelievably high. But I mean, they're charging ahead while Intel is not. Discretionary sector, no. But Amazon, I've been in Amazon. There's Apple, then an Apple. And as you can see, you can get to 21, and then it drops a little. So the first 21 stocks are all hitting yearly, if not all-time highs. So what I can do is I can save those. Out of those 275 stocks that I have listed, let's just save the top 21. I'm going to put them in. I'm going to replace my stock list. Whatever was in there, it's now got 21 ranked unique stocks. That was spotting opportunity. That was just a quick way of, looking at something that, if it's high today, good chance it's going to be going higher tomorrow. William O'Neill, who was the editor and founder of Investors Business Daily, all right, was called Investors Daily back in the day, was always famously quoted for saying, "I don't buy low and sell high, I buy high and I sell higher." And so that's exactly what we just did. We did the William O'Neill scan, all right, or one of his favorite scans. And so what we're going to do is now I want to show you, we're going to take something we call Double Finder. And that's where we're going to create that acceptable or low risk trade. So if we go to, again, Double Finder is something we can find on the tools. And what this does is I go into single search. We have all kinds of searches. We have singles, we have multis, we have any saved searches. I've got my searches. I've got darknet searches, which we have as well. We have a moving average searcher. And I'm going to get into the moving average one next week with you. But take a look at this. So I'm going to come down here to find Double Finder. And there's Double Finder. Now, Double Finder, and I've already kind of got in the information that I want. All right, how many calendar days I want to expiration. When I compute my percent to double, how far out do I want to go with my options? And I even have my ranking criteria to come out and show me the lowest percent to double, which basically means if I'm confusing you, how low, I want to find a stock that has the least amount of movement to where theoretically the options that trade on that stock will double in value, the near money options. That's what we're looking for. So we could do this with every stock, but why? Why not do it with a stock list, a small list of stocks that you have patterned to go higher? Right, so that's what we're doing. So here, I'm just going to come down here. I got pennies and weeklies loaded up, but I don't want pennies and weeklies. I want my stock list. Those 21 stocks that I just saved. There it is. That's what I want. It's going to take me all of no seconds to get that going. And look what we have here. So XLY pops up and says basically if the ETF XLY, by the way, here's a pic of XLY. Look at that. Hey, it's going higher. It's on. It's closed at a new high. Okay, Tom's not wrong about that. Over here it says the call percent to double if the stock goes up. All right, if the stock goes up 3.24%, then this option here, the October 19th 117s, should theoretically double in value, based on the Black-Scholes option pricing model that we use to calculate this information. Okay, so that's an interesting way of looking at it. Now XLY is on here, but XLY, let's see, which one was I mean, I was looking at these in a number of different ways. What I also did was I came out here and I said, all right, well, you know what? If I'm going to target something, why don't I target 9/21? Because there's a reason I like I think 9/21 is an important date, and that is that I just, next week you'll see there's a tide, there is a turning. All right, there is a turning that's happening in the market here in just a few short weeks. So can I get a little bit shorter on expiration? And I'm looking out here, and it really isn't showing me anything that I can't do much differently. But I go along here and I see, all right, here's AMD. AMD, look what the stock has to do. The stock has to move 15% more than where it is right now in order for these options to double in value, where, once again, 3.31%. So at this point, I might say to myself, all right, we've looked at the picture. Picture looks good. All right, it's moving along. Maybe I might want to look at this option as an example. So what is the option? The option is the October 19th 117 calls for $2.29. Right. And so that shows me the stock, shows me how much the call option is, right? But if I want to take a shorter term approach, because maybe I know as a pattern trader that mid-September to mid-October is typically the worst month of all month, worst time frame in the entire year, other than January, where the market's likely to go down. So if that's the case, maybe I might want to go in and edit this. Okay, so I look at this trade and I think, all right, this is not a bad idea, but what if I were to edit it? I'm just going to edit the trade real quick, and instead of October, I want to choose September 21st, right? So I want to take a shorter term approach to this. So if I do that and I click on risk graph, now we're going to look at the risk graph for the September options. Now the quote on that, the price on that's going to be less. Now it's not $2.29, it's $1.50. $1.50 or $150 for that option contract. Okay, so I look at that, and that gives me an idea what the cost is going to be. What's my risk? My risk is what I paid for the option, right? We can see in the next couple weeks. I mean, is it safe to say that if you know, I mean, we could see this thing move up into potentially the low 120s, and that would put you in a double. Easily put you a double. But what if we went down? What if we got down into this area here where we went from 117 to, let's call it 110, a 7-point drop in the stock? All right, well, if you owned 100 shares of this, you'd be down $700. Over here, if you owned a call option for every 100 shares, the worst you do is $150. All right, so that's the protection part and the safety part of options when you plan them out properly. In the next few weeks, what you will not hear come out of my mouth is, I think something's going up, therefore I'm going to buy it. I don't think, all right? I do have a brain. I just don't think when it comes to the markets, because thinking something goes up or down involves greed, fear, intuition. And those three things just typically do not mix with the word profit. All right. For me, I like to have objective trading strategies. And that's what we're doing. We're taking something that is buy the high and sell the higher and utilizing that. All right. So that was one I wanted to share with you. So that's XLY. And, you know, I take a note of these things. So what I do is, if I like this trade, and I'm going to be following this trade along. So I've got the XLY. In this case, it's now the SEP 21. So I'm going to change this to SEP 21. And I'm going to put out here on the end, I'm going to put Tom's Trading Essentials. So everything's going to start with TTE. Now I'm going to save this. So I have now saved that trade. I'm going to follow up on that trade over the next couple of weeks and just see how things are moving along with it. Now, when it comes to actually placing the order, you know, I'll place the order, I'll place it as a limit order. And the other thing I'll do is, if I get filled on this, I want to, at a minimum, sell half of this if it doubles in value, because I love taking house money. I like taking my money off the trade and letting house money run. Okay, so that's just one of my rules. Sell half when it doubles in value. And typically with ETFs, I actually even a little bit more conservative from that. I'll sell it when it reaches 50%. So what's 50% of 150? All right, that would be 225. So if this reaches $225 per contract, I will get out of half. In order to get out of half, what's the minimum number of options I need to be buying? 2. You can't get out of half of one option. Okay, can't be done. So you have, you know, and I'm not suggesting anyone buy anything in here. I'm just letting you know, in order to follow a half out at double, you have to have a quantity greater than 1 in order to do that. Right? So spot the opportunity. We did that with HILO. Creating a low risk trade, we did that with Double Finder. All right, we just basically used a scan and another scan. We spotted the opportunity with a scan, we saved that scan, and we ran that updated scan of those stocks into something called Double Finder. So it would then reshift them and tell us which stocks, in this case the ETF, had to move the least in order for the options to double in value. That's a very valuable tool right there. All right. Let's do it again, but this time we're going to do it with Darknet. So Darknet actually allows us to spot the opportunity and create the low risk trade all under one roof. Okay, so Darknet signals are very similar to Elliott Wave. It means it's a contrarian strategy using channels. What differs is that the signals are steadfast. That means that they stay put, meaning that they never change. All right, any of you in here who have ever traded Elliott Wave, I love Elliott Wave except for one thing. When the wave count changes, all of a sudden it's like as if the one before never existed. I hate to tell you, but if I was in a wave 4 buy and I actually bought something and it changes and says, oh, no, it's not, I'm going to go back and say, oh, yes, it was because I placed that order, right? That's something that just doesn't happen with Darknet. Darknet is a buying strategy only. That means that it doesn't give bearish signals, at least now, all right? There is some work that is going on behind the scenes to create the bearish side of Darknet. If we get some headway on that, I will let you know. I would love to see that, absolutely. This is an example of what we call channel collision. Okay, here's a stock that went, that kind of dropped down, went into a little bit of a range, and then started to create a higher high and higher low scenario, and then had a pullback. But as you can see here, we've got a long-term trend, which is bouncing off of support. We have a medium-term trend, which is bouncing off support. And we have a shorter-term trend, which is getting very dangerously close to support. So what we have here is we have what's called channel collision. Channel collision is when we're getting more than one support area being violated at once, right? That is the basis for Darknet. And here's that same stock where we've had before buys and sells and buys and sells. And oh, look here, the buy that came today. This stock is Coca-Cola. Coca-Cola had a buy signal today. Now, I will, full disclosure, I was buying calls on Coke before the close, all right? So I bought call options based on this actual signal, okay? So in this case, what we do is, from here we go from looking at the low risk trade to actually trying to create, looking for that opportunity to create that low risk trade. Well, that low risk trade can be created by simply going and, let me bring up the actual chart. Let's go to tools. Let's go to stock charts. And over here, I'm going to type in KO for Coca-Cola. And then for Coke, notice the pullback. Now, let me show you the chart type. So my chart type, if I go to Darknet and click Update, you'll see the buy signal. There's the buy. There's the sell from a previous buy back here. So winner, 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 and now an entry. I like that. This has a nice long pattern of winning. Okay. So in this case, now I want to create that low risk trade. So what I did was I go to options, I go to option chains. It's automatically going to put Coke in there. All right, I'm looking at the SEP 21 options that have 17 days left. So I'm going to go ahead and update and just look at those. And as you can see here, these SEP 21 options, I was buying these, and I actually got filled at 91 cents. That was my trade. The SEP 2144 calls. I'm just going to put one in there so we can follow it. So click on risk graph, and it's going to give me the risk graph for that trade. And look at this. This is a skinny, skinny trade. All right. The worst I can do is lose 91 cents, per option. The best I can do is if we get back up here anywhere near the highs, I'm seeing a double on this trade. All right. 116. I don't have to get that high. Let's see if we move this down a little bit. There's 97 right there. 45.89. Move it a little bit lower. That's too low. Yeah, like $45.50, I think, is my double point for this particular stock. Where's it at right now? 44.50. Sorry, close. The close, 44.76. I really need maybe a 75-point move. All right, 75 cents move, Don't need a lot of move on this one. So I am just showing you what it is that I did, not suggesting that you go out and do it, but you can follow this along as a case study. All right, so we talked about XLY. We talked about Coca-Cola. Now, how did the Coca-Cola piece come up? Well, I'm going to show you how that came up through Darknet. So Darknet, again, is a list of stocks that have created channels. And we get signals almost every day where it'll come out like this, and it'll show me stocks, and it'll show me the stock, and it'll show me an example of a call option, and we'll go through and look at slippage. But we've actually updated this. I want to kind of show you how this actually works. So let's look at some case studies. So I'm actually going to go to Darknet this time. Now to get to Darknet, let me just show you where we were. So you log in and it looks like this, right? The second area, which is called Contrarian Trader, that's our Darknet channels. So I click on the actual Darknet channels, and I've got what's called stocks only. Now I can rank this a number of different ways, but if you can see here, I've got, this is my buy list as of right now. What's bullish? All right, bullish signals. ETE, PSQ, there's Coke, there's IIIN, CCO, and then the list goes on and on. Now below that, you'll see stocks that got stop signals. That means they were done going up, according to Darknet. So we'll look at each of them for a moment, but take a look here. Now, if you get something that has an R beside it, has a little R down here, that means it's a rebuy. That means that's another chance to get in. And then there's an A. If you ever get an A, that means that's a third, an add-on. So there's actually 3 different entry layers that are in Darknet. If you look at Coke, we looked at Coke already, but I want to share that with you. There's Coca-Cola, there's the buy, all right? What's PSQ? That's pro share short, all right? You can see here, buy, rebuy, sell. Well, that was a good one. Buy, rebuy, sell. Looks like the rebuy made money, but the buy didn't, and here's a new buy from here. I'm not a big fan of these ultra shorts, right? Not a fan of ultra shorts, but they're in here. But look at the stop signal. So what's RGS? All right, if I click on RGS, that's Regis. And you can see here, the buy signal that came into Regis was back near the beginning of August. All right, so a month later, the stock went from a little more than 17, call it 17 and a quarter, up to the sell signal today, which was at 21.20. 17 and a quarter to 21.20. That's a good 4 points. 4 points on a $17 stock is amazing. All right, ETM. This is for those of you that want to follow along and kind of back test. This is a great way to do it. Look here, add on sell. Here's a buy and a sell. Here's a buy and here's a sell. Okay, so all those trades were winners. Let me move along here. Let's just see if I can find something. Is this Noble? NE, Noble Energy? Yep. There's a buy at 4. There's a rebuy at 3.5. There's a sell at 4.75. Here's a buy at 5. Call it 75, and here's a sell at 6.25. It's a small dollar stock. Might be worth just buying the stock on it. But I just want to show you that. Now, you might say, well, what about these ones that are in red? Let's look at the worst one, Cenex. Again, this particular strategy isn't 100% accurate. Here's a buy at 16, a rebuy at 14.5, and a sell at 12.5. Now, one of the rules that I use personally with Darknet is I don't like trends that go down. If I see something that has a new low in the chart, I'm not in it. I need to see higher lows and higher highs. That's what gets me excited for Darknet trades. So, we look at something like, let's see what INT is. So INT did have a buy and a sell. So it made a move up. Then it had a buy right here. This is a lower high, looking for a higher high. That's what I like to see in these trades. So you can add some additional criteria to the foundations of this particular trading strategy, but I find it to be a very, very effective strategy. So my Darknet trade for you tonight was Coca-Cola. Coca-Cola, I think, is a great defensive stock, right? When you look at the market getting the jitters like it kind of is right now. And so I wanted to share that one with you. So that's Coke. All right, so we've looked at XLY, we've looked at KO, and let's see if we've got anything else in the Darknet signals that might be something worth taking a look at. So I'm going to go back and I'm going to click. We don't even have to click on search. We're right there already. But if we take a look here, one of the things I like to do also is we're searching on all Darknet stocks. If I go to any kind of a finer list, like for instance pennies and weeklies, now I've got ETE and I've got WFT. These are stocks that have good, Weatherford. Now Weatherford, I see the low on the chart is down here at $2. I can't trade Weatherford; it's too cheap. It doesn't work for me. All right, but you can kind of get an idea of how I look at these. All right, I look at these to see, is the trend, do we see higher lows and higher highs, or do we see a new low on the hard right side of the screen? I don't see a new low yet, but I'm not really liking this one, and it's really because of the stock price. ETE, I think we looked at earlier, energy transfer, but look at energy for a moment. So higher, higher low, higher high. Buy and rebuy are sitting right there around support. This is good, right? $17.50. Let's take this one a little bit farther. So $17.50 for energy transfer equity, right? So what we can do is we can take the stocks only, and let's look at call option trades. Does it give us a good call option trade? Right, it does. ETE, and we're looking at maybe the SEP 28, and this says 17 calls. I want to look at this one because again, I like to add my own little flair onto these things. The 17 call, I mean, if we get up to 18, obviously, what's going to happen is you get a 17 call for 94 cents, and the stock's closing at 17.76. So it's already most of this is real value. That's good. It would need to get up into the 18.5 area, really closer to 19. It's got to get closer to 19 before you'll see that double occur, but it could do it, right? Now, one of the things I might look at is, can we go to the 16 call? And does that make it any better? Does it give me more real value in less time? Okay. So XLY, KO, and then ETE are three different ones we will be following for the duration of this series. All right. Mr. J, any popular questions?
Hey, Tom.
Any questions?
The one that's standing out the most is, how do you determine how far out for an expiration? I've been answering that these typically work within the next 30 days or less. And so
that's exactly what this is. Darknet is a 30-day trading strategy. All right. So Darknet itself was designed and was actually featured. Darknet was actually featured in a trading magazine a few years back. And it was designed as roughly a 30-day trading strategy, and I'm talking 30 calendar days on average, right? So it is more of an income type of strategy. The majority of the signals that I get are typically based on calls, just buying call options. Every once in a while, I'll get something that may warrant getting a spread instead of a call, but I'd say good 90% of the strategies that I get on Darknet, I'm simply just buying a call option, and I'm setting up my exits from there. Whatever I get filled at, get out of half when it doubles in value, hold the remainder until the 30 days are up, unless Darknet gives you an exit, which they do. I mean, there are, it has some. If I were to take you back, let's see if I can grab something here that's in the Darknet program. Let's go back to signals again, and let's see. These are all stops, but if I could grab the Coke trade again for a moment. Okay, so what happens when you're in a buy is that once it gets a nice thrust to the upside, it starts to pull back a little bit. You'll start to see these dots that appear. All right, these are parabolic stop darts. And so these stop darts start to get closer and closer to the lows that occur. And once we have a day where it pierces that low, that's when you grab it, when it stops out for that particular day. All right, but I'll tell you this again: the average time that happens is in the 30-day time frame on average. All right.
And then Thompson was just wondering if the 16 strikes more attractive than the 17, and then that'll wrap it.
Let's find out. Yeah, let's go ahead and find out. So calls and puts, that was a different one. Let's see. This was XLY. This was Coca-Cola. We're eventually going to find the right one. Coca-Cola again. And we're looking at ETE. So you know what? I'm just going to go to ETE. We're going to look at this 17. And what I want to do is, anywhere in this area, I can click on, edit. And I want to see what the 16 does. So in this case, I'm just going to change the strike to a 16. and then I want to look at the risk graph. And it's going to reprice it based on what the 16 went out at today. So the 16, I'm going to say 16 is probably, yeah, okay. So the 16 showing the ETE 928.16 call shows, it shows 87 by $1.88. Now there's a problem there. When I saw this 138 here, that makes no sense at all. That means that there's low liquidity in this particular option. The bid-ask spread is either too high or something's severely wrong there, because I would never sell that option for $1.87. However, $1.88 sounds correct. I would be a buyer at $1.88. But still, that only gets you a couple of pennies more in your favor. So the answer to the question, at least in my mind, is I'm happy with the 17s. All right, but it's good to always check. That's the most important thing. It's good to always check those. So homework. What I want you guys to do is I want you to follow those trades that we did, and I will email you each of those trades so that you can see those and follow along with them. And remember, what did we do here? Again, we used opportunity, HILO, and darknet to find these trades. And it's just a matter of creating them. In some cases, we used Double Finder. In other cases, we used darknet. And it's just a matter of following our rules. All right. I have some darknet video links on our site at tomsoptiontools.com. And by the way, we just put up, Mike Wade actually just put up a high-low scan, didn't he, Jay? Just did.
He sure did. He sure did. Yeah, it's the most recent video we posted so far.
So if you want to check out the high-low scan and how Mike uses it, and he just has a little bit of a different variation, but you can check that out as well. And that's at tomsoptiontools.com. And by the way, if you have not tried our software and checked it out, you're welcome to go check it out. Free trial, www.tomsoptiontools.com. Just look for the 7-day free trial, and it's a full free trial. You just pick your category of what you want to get a free trial on, and that is either our option trader, which is just options, the contrarian trader, which also comes with the darknet tool I featured tonight, and then of course there's also the complete trader, which is options, darknet, and the money calendar, which I'll be showing you that software and how I use it. That'll be next week. All right, so that's our homework for the week. Next week we'll be doing a review of the homework in week 1. I'll be talking about vertical debit spreads and trading with a money calendar. I hope you guys found the last hour, hopefully you found it somewhat educational. Follow along with the trades. I think, obviously the real results is how things do. And, sometimes I'm on fire, sometimes I'm not. Most of the time, I have consistently more going in my favor than not. But only time will tell from these things as we move along. Next week, I want to show you why I see the easy money leaving and why I think over the next month or so, it's going to get a little bit more dicey, and why we want to be, use some different type of risk trades, more conservative stuff. I'll be showing you that next week as well. So, hey guys, thanks a lot for being with me. I'll have the email out to you late tonight, along with this slide deck. So you'll have this slide deck along, and I'll put the trades in the text that comes with the email, so you can follow along with those. Thank you very much. Enjoyed it. I hope you did. I did. I'll see you again same time next week, and we'll continue from there. Thanks, everyone. Have a great night. We'll see you next week. Bye now.